Good morning and welcome to the Orlando Real Estate Buzz. I'm Brenden Rendo with the Homes in Orlando team and come to you every Thursday with both the national and local real estate news that's making a difference. Today, big news is really all concentrated around jobs. All kinds of different reports have come out this week. We'll see how that's affected the 10-year Treasury. Then we got the Fed watch because we got the meeting coming up on the 17th right now. And then we're going to look at the Orlando numbers, which for the end of August were absolutely dismal. So give us a moment and welcome again to the Orlando Real Estate Buzz. All right. Well, heading into the Fed meeting coming up, looking at rates. The big thing that Powell came out with in Jackson Hole was kind of moving away from the inflation number. They actually did away with the whole average inflation number, so I don't know how they're going to measure that anymore. And really said he was going to start concentrating on the jobs number. And today we're going to see why, because there's a lot of information out there right now that shows that the economy, at least for jobs, is really, really starting to cool. We had what's called the JOLTS report, which is the number of jobs available out there. And we've dropped to roughly about 7.2 million vacancies. And that is one of the lowest numbers we've seen in a number of years. Remember, during the pandemic, 2022, 2023, we had roughly about 11 million. So we've seen about 4 million job openings just kind of vanish over the past couple of years. So that's got a lot of people nervous because for the first time in a long time, there's actually more unemployed people than there are job openings. That number is actually about 0.99%, which not very far off, but basically now there's less than one job available for every person who's unemployed. So those numbers aren't exactly great to look at, and the numbers have continually over the past several months trickled down. Not fast, but it's trickling. Then the other thing that came out today was our ADP numbers. Their projection was 65,000. So we came in at 54,000, which was under expectations. So again, here's consistent news where we're not hitting our numbers for the projections we have. And if I'm Powell and I'm looking at this, I'm starting to think that we got to do the rate cuts. Because that's really the only tool that the Fed has in their toolbox is cutting the rate. The other is the printing of the money and the devaluing of the dollar, which is accelerating as well. So we got that, and then we come in and we've got our unemployment numbers that came out this morning. And our initial claims increased about 8,000. Again, nothing major, but the stagnation that's happening in unemployment, the having less jobs available, people, not getting jobs as quickly. It's really starting to I think weigh on the Fed, and I think we're headed back into a period of time which is known as stagflation. Stagflation was basically we had high inflation and high unemployment, and it looks like we may be headed in that area again. And then the final report we got is what's called the Challenger Jobs Report. And this is the layoff report. So in the layoff report, we had roughly about 86,000 job cuts in August. That's up 39% over July. Again, not good news for the job market. So all this information weighing on the Fed is we really have jumped to where 97% of the market feels that we're going to get at least a quarter point drop. I think it will be a quarter point. I haven't seen anyone really say that we'll go to a half, but I think it will be a quarter point. And I think if this data and this trend stays consistent in the job market, we're going to continue to see those cuts. So we may get another one in October. I don't know how far they're going to go, simply because of the fear of inflation. And based on what we've seen in other countries, other areas, specifically the EU, where they had preceded us and cut their central banking overnight rate several times, and they're seeing their inflation spike up to over 4%, and they're seeing their bond market head the complete opposite way of where they had hoped. And that's really kind of the fear that I have overall, is that, right now in the 10-year T bond market, which, we always emphasize that this is where we're looking in the real estate industry for guidance, is the 10-year kind of dipped. I think it dropped down to about 4.17 early this morning, starting to come back up to 4.2. And the biggest problem here is the national debt. As long as the national debt continues where it is, I don't see this number dropping. I see it actually going up a little bit. And something we saw earlier in the week is in the long-term bond market. This was a little scary because you can see we actually got up to about 5% on the 30-year T. What's that telling you? That's telling you that a lot of people don't have a lot of faith in the United States paying back its debt. And if you're going to want to borrow all this money, then we're going to want a higher interest rate. What spiked this was kind of interesting, because this was actually when the one of the lower courts struck down Donald Trump's tariffs, said they were illegal, and a lot of people feared that they were going to have to pay back all the tariffs. And you're talking, maybe $500 billion worth of tariff money that we've brought in. August was extremely high as well. So people kind of panicked a little bit and thought, oh my gosh, we're going to have to pay back all these tariffs. Well, I don't see that happening. And of course, immediate appeal of the lower courts ruling on the tariffs. But still, the more we borrow, the higher this rate is going up. And that's the scary part. And I think a lot of people just don't get it. They're just not seeing this overall. And another thing that came out this week, and it's not just me saying this, but it's also actually Fannie Mae. Fannie Mae came out with their quarterly projections this past week before Labor Day. And when you look at what they're projecting, everyone's, rates are going to come down, rates are going to come down, rates are going to come down. No, I don't think so, and either does Fannie Mae. When you look at their projections over the next several months and into next year, they're still projecting for the fourth quarter for interest rates to be around 6.5 on the 30-year. And then maybe a little decrease, 6.11%. And then going into mid next year, hopefully maybe come down to 6.2, 6.1. And if the bonds aren't going to, yields aren't going to come down, the only thing that's going to force that to come down is the spread between the 10-year and mortgage rates currently, which I've been preaching all year. That's the only thing that's going to bring the rates down. So for all the people who are waiting, and there are a ton of people sitting on the sidelines, a ton of buyers sitting on the sidelines that are waiting for that little bit of interest rate reduction. Don't count on it. I don't see it. Fannie Mae's on the same page that I am. And then you look at their projected mortgage starts, then also uh, where they see the bond rates staying for the next year. They're projecting 4.5, 4.5, 4.5. So they're not projecting that 10-year, or excuse me, that's the unemployment rate, but 10-year note, again, 4.5 right across the board for 2026. So they're projecting consistency across the board. And the only thing that can bring that rate down is going to be that spread change. So Fannie Mae's, telling us that, hey, we're looking at maybe 4.2 to 4.4 million homes sold next year. So the market's not going to pick up anytime soon. So you've got to get, as sellers, you've got to start really concentrating on your homes. What's going to get the home to sell? Number one is you got to price it. The days of overpricing homes is just gone. It's gone. People are financially savvy. There's so much data, so much information out there on so many platforms that people really know what the value is. And when looking at different numbers, looking at the number, that we've looked at over the past couple of weeks, when you're seeing 60% of the homes in Orlando sitting on the market for over 60 days, that's a real problem for sellers. I went back yesterday and looked at the number of expired, withdrawn, temporarily off market over the past 6 months. And there was 1,200 homes just in Seminole County that have pulled themselves off the market in one way or another and have not gone back on. I cross-reference, and they've actually have not gone back on the market. So a lot of sellers just pulling their homes off the market right now, trying to wait it out, trying to, hope, like just like the buyers, hoping that they can catch it at the right time, hoping that that interest rates are going to come down. And it's a losing bet at this moment. It's not going to drop to where everyone is expecting it to. You see people, oh, it's going to come down to 5.5, go back down to 5.5, and the whole market's going to open up. No, the fundamentals are not there. Not as long as we keep spending all this money. So as a seller, again, first thing, price it right. Price it right. Set your level of expectation correctly. Average days on market has gone up to 70 in August. So you need to set that level of expectation correct. And third, and probably one of the most important, make sure everything in your house is fixed and the house is clean. People want to just come in and move into a house. I was speaking with an investor on one of my clients who has to sell her house because unfortunately she's gotten so far behind on her taxes and she has to sell the house. And what normally I could have sold in 5 minutes, back 3 years ago, we're not able to do that. And we've got to go in and we're going over numbers with the investor on how much are we going to have to put into this unit so that he can turn around and resell it at what the market value is. So you got to make sure that is happening. And then 4 is just make sure that you're out there marketing, that your agent's out there marketing, not just putting it on the MLS. Anyone can put it on the MLS. That's easy. But we've got to get creative in the marketing. One of the things that I've did is I pulled the U-Haul report. U-Haul puts out a freaking tremendous report every 6 months that tells you where everyone is moving from to Orlando, which is fantastic. And that helps me and allows me through Google and through YouTube, which are my two ad formats that I concentrate on, allows me to target those areas that people are moving from. I actually didn't realize it, but there's a ton of people moving from Atlanta to Orlando. So I'm shifting some of my focus to the Orlando area, people moving from Atlanta to Orlando. And that's the kind of information we have to stay consistent on and always update everything. So that's the thing as a seller you've got to concentrate on. If you don't, your house is going to sit. And you can't be afraid to hear the tough answers. A lot of agents will just take listings to take listings. And to me, that there's no benefit to that. Our job is to sell your house. It's not just to get a listing to get a listing. Um, you know, Having it overpriced, by 20, 30, $40,000. It's going to sit. It's going to sit. That's just when we look at the data today, that's what you're going to see. They're going to sit. You're going to get frustrated. You're going to pull it off the market. So let's hop into our Orlando numbers. Nothing sweet for the end of August whatsoever. Our single family home sales actually dipped under 400, which surprised me because this was the end of the month. Usually end of the month, we always get a spike. We did not get a spike. Yeah, and then you see the single family inventory actually decreased about 30. Again, people are starting to pull their homes off the market, having to hold on to them longer. Then our condos, what can you say about condos? It is a completely depressed market. 95 homes for the last week of the month. That's horrible. Absolutely horrible. Then we start breaking in and we look at our numbers, of months of inventory. We've actually jumped to 5.6 months of inventory. This was saying about 5, but again, because of the lower number of sales, it's going to pop up. And then you look at our over 1 million, we've got nearly 9 months of inventory on $1 million homes. And I have seen just a ton of these homes come on the market. A ton of builders building $1 million, $1.5 million, $2 million homes, and they're sitting. I have a builder who's got an absolutely beautiful one in Winter Park off of Temple at $2.4 million. And it's going to sit because people don't see the value anymore. And when you're looking at how much people are dropping on the price there, you're averaging a $200,000 price drop off the home. So that's nearly a 10% price drop from the original list to the final sales price. That is a big spread. And then overall, when you look at the average, we're sitting about 93% from original to sales price. So you're looking at about a 7% price decrease. On a $400,000 house, that's $28,000. That's a good chunk of change. And then here's our days on market, and we're seeing this get pushed up again. We had been sitting in the 60s, but we broke into the 70s. And interesting, where are the ones sitting the longest? Believe it or not, the under $250,000 homes are sitting the longest. And why is that? That's because a lot of these homes need a lot of work, and people just don't want to have the time, don't have the money, and don't have the inclination to buy a fixer-upper. A lot of these can be great values, but a lot of them you're going to have to do a ton of work on them. And people just don't want to do that anymore. Then we look at our sales graph, and you can kind of see here since April, we're kind of flat, but actually kind of a little bit of a decrease on the overall sales. And then this, I've been watching very closely, and I thought we would start to see this, and that is the number of foreclosed sales is starting to increase, and the number of short sales is starting to increase. And then here's our days on market. Again, you see, we're jumping up into the 70s now, and with people pulling their homes off the market, inventory is coming down a little bit. Not a ton, but it is coming down a little bit, which I think we're going to see pretty much a flat line on the inventory through the end of the year. Just because it's that time of year where you don't see as many listings coming on the market. And I think we're going to see more and more people starting to pull their listings off the market. And then this is surprising. I knew it was going to spike, but I didn't think it would spike this quickly. And this is the number of short sales. So the number of short sales, we've gone from about 45 to 65 in just under a month. And I expect the number of short sales to continue to increase. And what this is from, again, is people who bought at the peak of the market and now have to get out, and the values are not there. The values have either flatlined or they've actually come down a little bit. So that's our market. It's flat. It's frustrating for everybody. It's frustrating for sellers. It's frustrating for buyers. But there are, in frustrating times, there's a lot of opportunity. If you look and you look hard enough and you know where to look. So there's opportunities out there for you. Just take your time, reach out, ask questions, dig a little bit, and we can help sell the home in a quick manner, quicker than the market is right now, and we can help you as a buyer get the best value for what you are buying out there right now. It's a numbers game, and we just have to look at the numbers, and you can't stay within the box anymore. You have to look at different directions and different ways on how to approach the purchase or the sale of your home. Thank you again for joining us here. If you got anything out of it, please like, subscribe, as always, and we look forward to seeing you next Thursday. Take care.